It's been a bad few years for Buzzfeed. After a disastrous IPO in 2022, it's faced a tanking stock price, declining revenue, and a shutdown of its news division. But things only look to get worse in 2024. As Adweek's Mark Stenberg reports, Buzzfeed faces a fiscal cliff where it's in danger of being delisted from the NASDAQ stock exchange, which then would trigger a required payment on its debt. Such an event would be disastrous for the company's future. I recently interviewed Mark about the dangers of the fiscal cliff and how likely it is to happen. We also discussed all the mistakes BuzzFeed made that led up to this position. Hello, I'm Simon Owens, and this is The Business of Content, the show about how publishers create, distribute, and monetize their digital content. If you want to listen to an audio version of this show, subscribe to The Business of Content wherever you get your podcasts. And longtime listeners of this show know that it carries no advertising. The only way to support the painstaking work I do here is by becoming a paid subscriber to my newsletter. Subscribers get a half-hour introductory phone call with me, access to live office hours Zoom calls with me, and the ability to submit questions for me to answer on special bonus episodes of this show. Subscribe at simonowens.substack.com. That's simonowens.substack.com. Or just Google the words Simon Owens and newsletter. Okay, on to my interview with Mark. Hey, Mark, thanks for joining us.
Yeah, my pleasure. Thanks for having me.
So the reason I had you on is because you have written a recent piece in Adweek about kind of some of the financial woes that BuzzFeed has faced recently, which it's not really that recent since it's kind of a recurring theme, but there are things that are sort of coming to a head in 2024 that spell a lot of, potential pain and catastrophe for the company. Let's start with just talking about a little bit about those financial woes that it's facing. You reported that it's not only like facing some large debt obligations, right? It's also facing a potential delisting from the NASDAQ, right?
hmm Yeah. So the delisting and the debt obligations kind of go hand in hand, just in the sense of effectively BuzzFeed has these convertible notes, $150 million that it bought or financed back in June 2021. They mature this December, so fully 12 months from now. So quite a while, but it's $150 million. And the reason the delisting element is relevant is because BuzzFeed is currently traded on the NASDAQ. It's in the third tier, the lowest tier. It was actually demoted from the second to the third tier back in November. And its stock is trading below $1. And according to NASDAQ rules, that is not sufficient. It has to be over $1. So they basically got an extension until May 20th or so to get their stock back over $1. There's a condition, though, that if they are delisted from the NASDAQ, then those debt obligations that they have that were going to mature in December get expedited and they move up to July. So there's a world in which if BuzzFeed is delisted, then all of a sudden it needs to have $150 million in cash by July, which if you look at its balance sheet, it's really nowhere near having. It hasn't been profitable on a full year basis, I think ever, but most quarters it's not profitable. It hasn't been profitable for the last 3 quarters. So it doesn't have any cash reserves based on money it's throwing off. And it doesn't have much investment or cash in the bank, about $42 million. So it's looking down the barrel right now at a massive bill that it has to pay, and it doesn't have the money for it. And there is a world in which that bill is due even sooner than December, up in July. So that's kind of the financial cliff that we're talking about. And that's why there's some sense of urgency here. Though to your point, it's not like BuzzFeed is very new to financial financial pressure.
Yeah, and just to kind of just unravel it a little bit, like the way that the Nasdaq works is like once a stock goes under $1, then it triggers some kind of notification to the company, and then there's some kind of grace period, right? And then I think the company can kind of like appeal that decision or ask for some kind of extension, which BuzzFeed has done.
Exactly. It actually fell below $1 more than a year ago, and it got its original extension, I want to say, sometime around last summer. And then that extension granted them, or they were basically on notice of delisting until November. By that point, they hadn't gotten the stock back over $1, so they could have been delisted, but they basically appealed, said, hey, we're trying to turn the business around. Can we get an extension? The NASDAQ apparently does this with some regularity. It's not uncommon for a stock that's trading under a dollar to continue to get extended. So it's not necessarily a four-alarm fire. And in fact, the really important thing here is that in its recent extension, BuzzFeed basically said, hey, if need be, we promise that we will do this maneuver called a reverse stock split, which effectively is kind of a mechanism that allows them to take an underperforming stock and inflate its value by basically
By
reducing.
combining shares, yeah.
Exactly. So you have 10 stocks, you reduce it to one. The total value doesn't decrease, but the individual price of the stock does increase. It's a bit of a game tactic. And so BuzzFeed has basically promised if the situation necessitates, we will do that. So the odds of them actually being delisted, it's hard to say. They can do that maneuver. It could pop their stock price, but then it could go right back down. So it's kind of hard to say what sort of control they have over that price. But yeah, it's safe to say that if they're not able to keep it over a dollar and they do get delisted, they're going to have that big bill to pay.
Yeah, and outside of the debt obligation, being delisted also is bad because then it's going to become a penny stock, right? And then no institutional investors will touch it, and then it's going to be make that even harder for its stock price to climb. Would that be an accurate assessment?
Yeah, I don't know that any institutional investors are touching it as is. But I think that that would basically put it to bed in terms of this is no longer really an appealing stock unless you're trying to buy something for cheap and maybe make a play on it. It definitely opens the company up to a private acquisition, which a number of sources are telling me seems to be, if you're being cynical, the inevitable future of BuzzFeed, which is that it will either potentially go bankrupt and maybe go through a restructuring to make its debt a little bit more payable, or it will find a private buyer and they will take over it and begin to run it according to how they see fit.
And
So,
that's basically what happened to Vice. Basically, one of its largest investors bought it out of bankruptcy, right?
yes, it's three main investors, or it's three most recent investors. Um, and it's actually funny you mentioned Vice because one of the reasons this story was so interesting to me is because I wrote a story that basically combed through bankruptcy documents that told a chronological story of how Vice ended up going bankrupt, right? And it had not been generating positive cash flow quarter after quarter, year after year. It kept kind of plugging the gaps with more investment. But eventually, they faced a liquidity crunch in which they had a big payment due and a key vendor pulled out or ended a contract. And so they find themselves needing to pay somebody without the money to do it. And after years of kind of kicking the can down the road, the shit hit the fan and they were unable to pay and basically had to declare bankruptcy. It's funny because you can really have a relatively small payment, all things considered, be the kind of straw that breaks the camel's back if the financial situation is precarious enough. And looking at the BuzzFeed situation, I was seeing similar echoes. Here they are, $150 million. Theoretically, that's not insurmountable, but they're probably not going to be able to raise more financing, or at least not on good terms. They're not really throwing off their revenue to be able to do this. We can talk about their attempts to divest some of their assets and generate some cash through that. But it really seems like this could be a situation in which a relatively manageable payment is unmanageable.
Yeah, and then the reason why they had to raise all that debt is because basically, they've famously raised hundreds of millions of dollars in VC cash. They burned through that. But by 2021, they were in an environment where no investor was interested in like putting in actual venture capital investment, hence why they had to go to, get basically the credit markets or whatever they're called.
Exactly. Yeah. Again, same thing with Vice. As the situation got worse and they had more and more investment and their product seemed less and less likely to turn that corner, they had to take on worse and worse terms in order to keep that cash coming. The sort of the bill is coming due, and there's very few parties who are going to step in and help them that aren't predatory or at least opportunistic.
And then a few years ago, they purchase Complex magazine and also HuffPost. It seems like one of their maneuvers to try to avoid bankruptcy is to sell Complex at a loss, but maybe generating enough cash to in order to pay off its bill.
Yeah. So, and this is, I'm indebted to some reporting done by the Information earlier this week or late last year that was sort of one of the reasons I wanted to look into this. I've been reporting, as has the Times and the Information, about these efforts to sell Complex. The key factor here is that Jonah Peretti was hoping to get around $150 million for the property as well as Complex land. Turns out that price is going to be closer to $100 million. Had they gotten the 150, they would have been able to theoretically take that money and allot it to these debt obligations. But because it's 100, they still have $50 million of unaccounted for funds, and apparently the interest rates on that 50 million will accrue over the course of the year, such that that rate or that number could increase anywhere up to as much as $100 million. So it's an unfortunate situation because now this failure to get this price that they wanted for Complex is not only going to prevent them from being able to pay off this debt obligation, it's really not going to solve the problem at all. They'll be able to maybe put a dent in it, but they needed this to be a bit of a silver bullet. And it looks like it's not. So they're going to have to probably continue selling some other parts.
And meanwhile, their revenue is going in the wrong direction. They're actually year over year, their revenue is shrinking.
That is true. I will say one of the sources I spoke with did point out, fairly enough, some of the revenue margins have actually increased. The cost of production versus the revenue that they're taking in. Although revenue did go down, their margins got a little bit better. And they were predicting, as you would expect, a large Q4. So there is a reality in which their revenue is up substantially, or not up substantially, but flat maybe in this last quarter. And if their margins continue to improve, then maybe this Q4 is actually pretty beneficial for them. But yeah, I think the overall picture is, even if your margins are getting better on a negative cash flow basis, that is not going to save you.
So that's the current state of affairs. I was hoping maybe to kind of shift this conversation and talk about like how they got up to this point. And I kind of put together kind of a list of all the things I think they've gotten wrong over the years, and I was hoping maybe to run those by you and get your reaction to each one to hear your assessment on how much of that played a factor in it. Does that sound good?
Yeah, no, I love this. Let's do it.
Okay. So first one is they went all in on platform distribution. I remember there was like a memo that Jonah Peretti, this was like 10 years ago, that he released where he basically was just like, he said something to the effect as, we don't care if BuzzFeed content is read on our website. Like as long as it's consumed somewhere, whether it's Facebook or Twitter or YouTube or something like that, that's fine to us. And this was back before it implemented programmatic advertising, and it was mostly focused on native advertising and its brand advertising partners. They were paying BuzzFeed to create content that would then go and spread on Facebook and YouTube and stuff like that. Like there was the famous Dear Kitty ad that they created for like some pet food brand. I would say that was the first major mistake, was going in all platforms. I think their departing publisher recently put out a memo stating that not only do the platforms not contribute to our business, you could even argue that it creates a negative contribution. Or I'm paraphrasing what she said. So what's your view on the big mistake is they gave in to the allure of the platforms and put too much of their business success on those platforms.
Yeah, I think that is it in a nutshell. I mean, there's a lot of sort of tangents that branch out from there, but that's sort of the original sin. And I think that is the original sin of other digital media companies that were born around the same time. My like humbug apologist nature here and sort of response to what you said is, I know you're saying, mistake or misdirected bet. I feel like I always try to like remind myself they were making the best decisions that they had with the information they had at the time in that environment. And you and I both know that people were chasing BuzzFeed. They were
Yeah.
clamoring
We were
for
all hailing them as
it.
geniuses. Like
They were,
Every
yeah,
Jonah Peretti memo, every publishing executive would read for
yeah.
some kind of insights on how they could become more like BuzzFeed. So
Exactly. So, and I'm not like a man in the arena type apologist typically, but I do want to, always kind of preface any criticism I have of these companies with a lot of people would have made the same decision. We were hailing them for these decisions years ago. Now, in light of new information and having seen the way that the internet's evolved, the way social platforms, their priorities have shifted, the way the relationship with Google has changed for publishers, and the way people consume content and produce content, they've all changed. So BuzzFeed bet on a horse, and that horse looked like it was going to win. And now that horse, they're taking it to the glue factory. It certainly, we can see, and I think say now that it was a mistake. But I don't think that at the time it was a misreading of the tea leaves. I just think the tea leaves have changed. So I always want to give them a little credit for trying something new. But I think ultimately, yeah, we've now seen that got to have that direct relationship. You got to make content that's invaluable to its readers, that want to go to your website, that want to read you on a daily or weekly basis, that will go out of their way to share your content and identify with it. And BuzzFeed was more sort of, if we become ubiquitous and sort of this passive presence in everyone's lives, that will be enough to sustain us. And I think we found the opposite to be true.
okay, second mistake. They raised way too much VC cash. I don't know what the current numbers were, but it's in the hundreds of millions of dollars. And based on my theory, this caused them to just burn through cash. They didn't grow sustainably. They made a lot of bad investments that didn't have actual business models, behind them. And then by the time that cash was all burned up, they had this huge infrastructure with a lot of overhead and everything like that, and then that made it difficult for them to pivot and do all this stuff because suddenly they were facing down lots of salaries and other kind of infrastructure costs, and it just like they weren't nimble as a result.
Yeah, absolutely. I mean, I'm sure you've heard that phrase where people say so and so was a zero interest rate phenomenon. To what degree are some of these digital media titans just ZERPs? BuzzFeed was built on that model of easy cash, and they never had to find profitability or operate with a lot of financial discipline. And when the money ran out, they kind of were left with their swim trunks at their feet. So I do think that's true. I'll say the one interesting thing there is, again, going back to this Vice story, one of the things that was most fascinating about looking through those bankruptcy documents is these companies raise money and do not tell the public sometimes. You know what I mean? Like, we know how much money BuzzFeed has raised, that it's told everyone it's raised. But I would be curious to see what other debt obligations does it have, in its deck that it hasn't shared, that it's still contending with, that we don't even know about. That was what was so fascinating to me about kind of that Vice autopsy of realizing, it's like how they say that the president is always making these decisions with way more information than the average American has. So sometimes we don't understand why they do what they do. It's like that a little bit with some of these private companies. They might have debt obligations that we have no idea about that are way more pressing. So we'll only find that out. Well, I guess BuzzFeed's public.
Yeah, I was gonna
So
say like maybe
that's not true.
yeah, maybe post public listing. A lot of that's more
Yeah.
transparent now.
Okay, I take that back about BuzzFeed.
Yeah. Yeah, but I
So,
can see
but
why
yes.
Vice, things like that. Not every move that they make is publicly announced. Okay, third theory on biggest mistake. They went all in on advertising based on this early 2010s assumption that basically there was going to be infinite growth there, that as long as you could scale audience, there would always be, advertising demand to scale concurrently with that audience. But not only did that audience, the scale was limited once the platforms choked off distribution, but the promise of programmatic ad tech really never came to fruition. Never achieved the kind of ROI and CPMS that the industry was hoping for. And as a result, once it became clear that that was the truth, like you had a company that wasn't very well diversified in an era when something like the New York Times is monetizing through, advertising, subscriptions, multiple subscriptions, live events, and then like e-commerce and with Wirecutter and stuff like that. But BuzzFeed ended up being just like not diversified at all.
Yeah, a source said something similar to me about like what can BuzzFeed do from here, and he was basically saying they've been around for a decade and a half, and they have no reader revenue products. I mean, they do a lot of licensing, and they do like through Hot Ones have some product lines. So they do have their fingers in a few different differentiated businesses, but for the most part, you're absolutely right. Like they've clung to advertising and especially digital advertising, programmatic advertising. We're seeing publishers more and more just kind of throw in the towel there and say like the CPMs are so low that at what point do we just it's either direct or maybe you just don't even have ads on your website. Like I don't know if we're getting to that point soon, but the programmatic market has gone in the wrong direction over the last decade. So yeah, BuzzFeed kind of staked its cart to that horse, and that horse has not done well. So I think that is also definitely a big reason for their precarity.
Okay, so those were the big three. The big three. Now I have some kind of other minor missteps that they had, and I wonder if you think these were bigger or relatively minor. One is I think like BuzzFeed was actually really innovative in the video space. Like developed some like really huge YouTube channels, like especially around 10 years ago, and was really kind of leading, at least in the publisher realm, and growing its video operations. But I think like one big mistake is like they didn't really understand how to deal with the creator economy. There was like a lot of like backlash from their own like video creators who ended up, quitting and then having huge careers as independent YouTubers. And and today they have a little bit better relationship with their creators based on what I've read. But that was like an early misstep where they were really early to capitalizing on the growth of the creator economy, and they could have like forged better partnerships with that community, but they like pissed off that community. I don't know. I mean, I don't know how much you were covering this back then, but is that kind of that assessment ring true to you?
Yeah, I think so. I think you're more familiar with their state of creator relations and just the creator economy in general than I am at this point, but that does ring true with everything that I've heard. Additionally, I think you can kind of chalk this up a little bit to time and place and the social media environment in which BuzzFeed was born. There were platforms that were a little bit more conducive to, I want to say, revenue sharing and creator partnerships and ad networks. And I kind of just contrast this to today where TikTok is obviously in the ascendancy, and a lot of publishers and even creators and brands have not really cracked the code on how to monetize it effectively. And in fact, the platform almost rejects external monetization in a serious way. I mean, there's still not like a great programmatic product. I don't think that there's any programmatic product.
Yeah, and they're just not good
So
at like selling in video sponsors like like individual creators are. Like I was talking to a senior video producer at Vox, which has an amazing video channel, and they'd only done one brand partnership their entire they have an amazing YouTube channel, I meant to say, but like they had only done one actual direct brand partnership in their entire tenure at Vox, and like the only way that they were monetizing their YouTube channel was just the programmatic through YouTube, which is decent, but like you look at the most mature like YouTube creators and they're like diversifying their channels in multiple different ways. And to your point, like publishers just haven't figured out how to effectively monetize these channels.
yeah, and the channels that face slip of the tongue there, but the channels that BuzzFeed kind of grew to ascendancy upon were like the Facebooks of the 2010s, and even the Twitters to a degree, where at that day and age, those platforms were pretty reliable sources of traffic. You could send people back to your website. You could say, okay, maybe we're not making a killing on these social platforms, but they're great for traffic. Nowadays, Twitter's hardly referring anything. Facebook doesn't have any news. TikTok doesn't really send any negligible source of traffic. So in that regard, being born on the backs of those platforms was a viable strategy a decade ago, but the social platforms have changed. So the creator relationships have changed. And BuzzFeed, whether or not it was able to or unable to adapt is, I don't know the question. I think it's this landscape that we have today is just not publisher friendly, the social media landscape that is. So it's hard for me to say they could have done X differently. And I don't mean Twitter. They could have, they could have done something differently.
That's what I hate. I hate that it's called X because you always use X as a stand-in, and then it's just like, oh crap, people are going to think you're talking about Twitter. I was just thinking about that today.
There's so many different like words that I can no longer use because they're now associated with, like meta.
Yeah,
or even,
yeah.
I mean, not to get political, but you can't say, I trumped you, or it has a Musk, or, there's all these words that now I can't use them.
Yeah. Okay, next mistake is investing in news. Now, let me say, I think BuzzFeed News was a great publication at its height, published amazing journalism, launched amazing careers, but in hindsight, it probably wasn't a good investment given that they've eventually shut it down. That's probably hundreds of millions of dollars that they burned through. That if you were to go back and tell Jonah Peretti, don't hire Ben Smith and don't launch a news division, that hundreds of millions of dollars could have been invested in something else that might today be more lucrative for the company.
Yeah, that's an interesting counterfactual because you could just as easily make the counter argument there that had they maybe monetized BuzzFeed News in a different fashion and tried to have some subscription product or tried to do, podcasts with the subscription, maybe that would have been the reader revenue that they needed. But I think they kind of looked at this fork in the road and then went off in some weird third direction. They launched a news product and then declined to paywall it. So they went in this strategy that like defies conventional wisdom on two different accounts. So I think that your point is accurate. I mean, imagine what they could have done with those funds. Absolutely. Maybe that would have cracked the code. But you could also say maybe if they just handled it differently, that might have been a little bit more sustainable, but instead they did neither.
Especially since they split BuzzFeed News into its own URL. Like you would have thought they would have at least tried some kind of paywall. Like even if it failed, at least they could have said they tried. But I think they were distracted by the HuffPost acquisition. Suddenly they had sunk all this money into that, and that had its own journalist, and it probably just muddled the waters way too much where you had this news organization over here and this news organization over here. You're burning through cash. It just like a lot of its options just kind of dried up at that point. And I guess that would be maybe the final mistake I would list is like an acquisition strategy that didn't really pan out with Complex and HuffPost, which it was supposed to be funded through their public listing. The SPAC basically blew up in their faces. All these committed investors pulled out at the last minute. Suddenly, they were counting on that money for the acquisition. They went through the acquisition anyway, and then here they are with tons of debt as a result.
Yeah. I mean, I think this will go down maybe in the annals of digital media as one of the biggest, steps on a rake. Like they bought this thing and then 2 years later sold it for a third of the value. And yeah, the Complex acquisition, I think, hasn't worked out for either party. And I have a lot of conversations with Complex people, and they feel, I think, rightly aggrieved by the whole situation as well. I mean, a lot of I think the original deal where BuzzFeed acquired Complex was half cash, half equity, something like that. So a lot of people were given BuzzFeed stock or equity in BuzzFeed as compensation, and now they're not seeing any kind of payday, and now they're being shipped back off to some other network where their fate is once again not their own. So I feel bad for Complex in that regard.
And it was a truly innovative company. Like Complex Con is one of the biggest success stories in terms of publisher live events, the merging of actual fan bases and consumer products. Like it was just this perfect mix because products like sponsors loved Complex Con because it actually moved sales, and then all the sneakerheads and other like streetwear people actually loved it. They were clamoring to buy tickets to Complex Con. Really successful, and then obviously really successful in building out YouTube programming with Hot Ones and stuff like that. So really successful, innovative media company that got swallowed up into this struggling conglomerate, basically.
Yeah, absolutely. And I think that there's a lot of lessons there for other digital media companies in terms of culture fit, which I think was a little bit overlooked in terms of tech platform fit. I've heard a lot of stories about like the two companies, they sold differently, they operated differently, they thought differently, they organized differently. And I think there's a lot of, you know, discussion several years ago about reaching scale and combining and just like increasing our total impressions by adding your impressions to our impressions. And there wasn't enough thought. I mean, you could say a similar sort of marriage of unequals occurred with Vox Media and Group Nine, where you're having a lot of people say, the Group Nine didn't really bring as much to the table as Vox was hoping it would. But at the time, it was, we're just going to combine these two reaches, and that will be worth it. So I think a little bit of a lesson there in terms of what makes a balanced portfolio. You have to take into consideration all these qualitative factors.
And that's the perfect segue into my final question is like, when you look at the early 2010s, there were these three digital upstarts that raised over $100 million in VC. They were looked at as like the darlings of, the successful models for what media was going to become in the internet age. You had Buzzfeed, you had Vice, and you had Vox. Now, obviously, there were lots of other smaller ones that raised money like Mashable and Mike and stuff like that. But those were kind of the big three. We all know that Vice has been in a terrible place. And then, obviously BuzzFeed is staring down the barrel, some really bad financial troubles. I have no idea if Vox is profitable. It certainly has had layoffs and has had some troubles, but it doesn't seem to have fared as badly as the other two. Like, do you have any theories on why that is?
Great question. I've been looking into this because my hypothesis, and from what I've heard from other people, is that last year when PMC made that investment in Vox, that was a sort of look under the hood, and that we might be seeing a situation in the not too distant future in which PMC gets even more involved in Vox, potentially even buys Vox. So we'll see how that pans out. From what I've heard, they're not profitable. But the balance sheet is more balanced. Right?
Because
The New
they're
York Magazine acquisition
Yeah, I was gonna
absolutely
say,
helps with that.
yeah, they're diversified. They have a subscription publisher with New York Magazine. They have a
Yeah.
lot of like niche verticals that are probably lucrative, like The Verge and Curbed, and lots of different. Like they're in kind of some consumer friendly verticals, and then they invested big in podcasts as well, which they claim is like a bright spot within their company. Who knows?
Yeah. I have also consistently heard that Jim Bankoff is a savvy financial operator. I don't know what that looks like in practice, but when it comes to the outlandish sums that were raised by Vice and potentially also BuzzFeed, the word on the street is that Vox might have been a little bit more safe in those in its yeah, conservative in its fundraising. I can't really verify that, but that seems to be what people continue to say. So yeah, I mean, there's a smart financial stewardship element. There's a diverse portfolio element, but ultimately, I don't think that they are profitable, and that I do think that they are probably themselves facing some liquidity concerns and some runway concerns. I mean, there's a reason that they accepted $100 million from PMC last year, and they continue to do layoffs, and they haven't made any acquisitions. I mean, clearly that money basically just went to maintaining status quo and keeping the lights on. So they might be a leaky bucket as well. I just don't think that it's as leaky as some of these other operations, but I wouldn't be surprised if they themselves are looking for someone to take them off the market.
Well, I hope you continue to report it out. And when you do report it out, I hope you will then come on to this podcast and talk about it. Mark, those were all the questions I had for you. Where can people find you online?
You can find me on adweek.com, and you can increasingly find me on LinkedIn and Instagram. But I guess I am very rarely on Twitter anymore. So just go to Adweek.
Awesome. Well, this is a lot of fun. Thanks for joining me.
Yeah, thank you so much, Simon.